So, what exactly is leveraged finance? Well, it's right there in the name. It's when a company is bought using leverage, which basically means a lot of debt. In other words, leveraged finance happens when a big corporate deal or acquisition is funded mostly with borrowed money instead of cash or equity. And we're not talking about small change here. We're talking about billions of dollars of borrowed funds powering a single transaction. Who uses leveraged finance? Pretty much anyone who wants to buy something big. Companies might use it to acquire other businesses, buy real estate, or fund management buyouts. But today, the most common player in this space is private equity firms. They use leverage all the time to take over companies. Let's take an example. Meet our private equity investor. Let's call her Sophie. Her firm wants to buy a company worth $10 billion, but she only has $2.5 billion in equity to invest. So where does the remaining $7.5 billion come from? Right, debt. Lots of it. And to get that financing, Sophie goes to a bank. Meet Ben the banker. Now, modern banks rarely lend that full amount themselves. Instead, they act as arrangers, connecting Sophie's firm with investors willing to lend the money. Ben might also underwrite the loan, meaning the bank promises Sophie she'll get the cash, even if they have to cover part of it themselves. Sometimes they also arrange bond issuances to spread the funding across more investors. The bank earns high fees for this, and while it takes coordination, it's far less risky than being the one actually lending the money. Inside the bank, this work is handled by the leveraged finance team. They're the ones who analyze the client's request, study the company's market and cash flows, and build the financial model to decide how much debt the business can handle. Once the structure looks solid, they present it to the risk department for approval and negotiate the loan terms with the company and lawyers. After the deal closes, the team manages the bank's exposure, deciding whether to keep the loan on the books or syndicate it to other banks or investors. In short, they're the bridge between corporate analysis, credit risk, and capital markets, making sure the deal actually works on paper and in practice. So now the deal closes, Sophie's firm owns the company, but the debt doesn't sit with her fund. It sits on the company's balance sheet. The business now has to operate under the weight of $7.5 billion in debt, paying interest and repaying principal over time. If performance weakens, bankruptcy is a real possibility. But if the company performs well and meets its debt obligations, Sophie's firm can make a serious return. Here's how. When the private equity firm eventually sells the company, let's say for $15 billion, they'll repay the $7.5 billion in debt and keep the remaining $7.5 billion. That means their $2.5 billion investment just tripled. That's the power and the danger of leverage. Because if the company fails and can't pay back that $7.5 billion, the lenders take over, and Sophie's equity is gone. So, leveraged finance is all about magnifying returns and risk. It's what allows private equity deals to deliver outsized performance when things go right, but also tighter margins and higher pressure when debt levels are heavy. In short, borrow big, aim higher, and manage the risk wisely.